Warren Buffett just invested billions in Japanese companies while hedge funds are pouring money into international markets. Meanwhile, the average investor is stuck in a loop of low-yield domestic stocks, missing out on 6% dividend yields and global diversification that could shield their portfolio during market crashes. Imagine transforming your investment strategy from a predictable, US-only approach to a global income powerhouse. There's an ETF that's returned an impressive 51% since inception, beating the S&P 500, while paying monthly dividends that could eventually replace your full-time income. Today, I'm breaking down IDV, the International Dividend ETF that's grown its assets by 30% in 2 months as smart money quietly piles in. Did you know that 90% of American investors have almost no international exposure in their portfolios? That's a serious problem. Most of us are trapped in what I call the home field investment syndrome, a stubborn preference for familiar US companies that's costing us serious money in both potential returns and dividend income. This concentrated approach creates significant vulnerability that could undermine your financial future. When you invest exclusively in US markets, you're essentially putting all your financial eggs in one economic basket. During the 2008 financial crisis, US-only portfolios suffered devastating losses, while those with global diversification recovered more quickly and with less volatility. The numbers reveal what we're missing. While most US companies offer modest dividend yields, between 1 to 2%, international markets frequently deliver yields between 4 to 6%, potentially doubling your passive income without excessive risk. That's money left on the table every quarter. But there's more at stake when you limit your horizon. The S&P 500 now has enormous concentration in a handful of large-cap tech companies, creating dangerous imbalances. When these tech giants stumble, portfolios across America suffer disproportionately. Meanwhile, internal markets offer exposure to different sectors entirely: energy, industrials, financials, and infrastructure companies that often provide more stability and higher income. Why do we cling to our US-centric approach? The psychological barriers are powerful. There's comfort in familiarity. Investing in household names like Apple feels safer than companies from Japan or Germany. We tend to overestimate foreign market risks while underestimating the concentration risks at home. Another overlooked factor is currency dynamics. International investments give you exposure to different currencies, which can become a powerful advantage. If the US dollar weakens, as many economists predict with interest rate cuts approaching, your international investments receive an automatic boost as foreign currencies appreciate against the dollar. The potential upside is compelling. International markets often operate on different economic cycles than the US, meaning they might experience growth while our domestic market stagnates. This counter-cyclical relationship smooths out overall returns and reduces portfolio volatility. What's revealing is how sophisticated investors are positioning themselves. While retail investors remain focused on domestic stocks, institutional investors are quietly shifting billions into international markets. Major hedge funds, pension systems, university endowments, and even Warren Buffett have been increasing their global exposure. They recognize that many of the world's most innovative companies aren't listed on US exchanges. The gap between average investors and sophisticated investors has rarely been wider. While most Americans continue piling into the same crowded US stocks, the institutions managing trillions are diversifying globally. The question is, which group do you want to follow? If you're following the smart money into international markets, you need a vehicle that's built for the journey. Let me introduce you to Amplify CWP International Enhanced Dividend Income ETF, better known as IDV. This powerhouse has delivered impressive returns while providing substantial monthly income, combining international exposure with an advanced covered call strategy. IDV has returned a remarkable 51% since inception, consistently outperforming the S&P 500. Currently, it's showing even stronger divergence. While the S&P 500 has posted a 2% loss year to date, IDV has surged ahead with an 11% gain during that same period. This ETF swims in a completely different direction than the market, making it increasingly valuable in today's economic environment where investments that move counter to broader market trends are essential. The returns are only half of IDV's appeal. Its dividend yield, approximately 6%, triples what you'd typically find in US markets. Think of IDV like having both a salary and a bonus from the same job. While most ETFs pay quarterly dividends if they pay at all, IDV distributes income to shareholders every single month, creating a powerful advantage for investors building income streams or reinvesting for compound growth. This impressive yield stems from two primary channels: qualified dividends from underlying international assets and additional income from its sophisticated covered call strategy. This dual income approach elevates the yield far above traditional dividend ETFs focused on US markets. Furthermore, IDV's dividend growth rate has reached nearly 12% over the last 12 months, 50% higher than average for ETFs in its category. This represents income that's growing at a pace that helps combat inflation and increases purchasing power over time. Investors are taking notice. Assets under management have increased 30% in just 2 months, a clear indication that sophisticated investors recognize IDV's potential. This influx of capital demonstrates confidence in the fund's strategy and performance. Compared to other high-income ETFs like JEPQ and SPYI, IDV offers a unique combination of international exposure and enhanced income. In today's investment landscape where diversification is crucial, IDV delivers both geographically and income diversification efficiently. IDV does carry an expense ratio of 0.66%, higher than many passive ETFs, but aligned with other covered call ETFs. This reflects the active management required for its sophisticated strategy. For many investors, the outperformance potential and substantial yield justify this cost structure. The real advantage of IDV lies in how it combines the best of both worlds, tapping into global growth opportunities while generating substantial income regardless of market conditions. This creates potential for capital appreciation during strong international markets and reliable income when markets move sideways or down. Beyond the impressive strategy and performance metrics, let's look at what's actually inside IDV's portfolio. Many investors don't realize that some of the world's most innovative and profitable companies operate outside American borders. Companies that are quietly dominating their industries while rarely making headlines on CNBC or Bloomberg. IDV gives you a backstage pass to the global giants powering our world. Taiwan Semiconductor Manufacturing Company, one of IDV's top holdings, produces the advanced chips powering nearly every cutting-edge device you own. Your smartphone, laptop, and gaming console likely contains TSMC chips. This Taiwanese giant commands over 50% of the global semiconductor manufacturing market. The fund includes companies like Tencent, China's digital ecosystem giant that reaches more users than Facebook through its WeChat super app, used by over 1 billion people daily. You'll also find Enbridge, Canada's energy infrastructure leader transporting nearly 25% of North America's crude oil, and Mitsubishi, the Japanese conglomerate spanning from automotive to banking. These established global leaders have decades of proven performance and market dominance. IDV's selection process centers on dividend growers, high-quality companies with proven histories of consistently increasing their dividend payments year after year. This approach targets businesses with substantial earnings growth and strong cash flow generation, creating a powerful compounding effect for its investors. The geographical distribution within IDV offers another strategic advantage. The holdings span developed markets across Europe, Asia, and beyond. This international spread means that when certain economies face headwinds, others may be experiencing tailwinds, providing a natural hedge against regional economic downturns. The fund's selection criteria are ruthlessly selective. Managers screen thousands of international stocks, focusing exclusively on high-quality, large-cap companies with sustainable earnings growth patterns. After exhaustive fundamental analysis, they narrow the universe down to around 50 core positions, forming the heart of their portfolio. This approach combats the severe concentration risk plaguing many U.S. portfolios. While the S&P 500 has become increasingly dominated by a handful of mega cap tech stocks, IDV's portfolio spreads investment across diverse industries and geographical regions, from consumer staples and healthcare to industrials and financials. This careful curation creates a unique investment vehicle offering genuine diversification combined with meaningful income. The international companies in IDV's portfolio operate under different regulatory environments, serve different consumer bases, and face different competitive landscapes than their American counterparts. This diversity helps manage risk while creating opportunities to capitalize on global growth trends that may not be accessible through US-only investments. That international diversity is impressive, but it's actually the fund's second income stream that might be its most powerful feature. While most investors focus solely on dividends, IDV employs a sophisticated strategy that essentially allows it to get paid twice from the same stock. This is where the covered call strategy comes into play, a technique that transforms the typical buy and hold approach into an active income generating machine. Think of a covered call like renting out a room in your investment house. You own the property, your stocks, but you're collecting rent, premium payments, by giving someone else the option to buy that property at a set price during a specific time frame. You keep ownership while earning immediate cash from the arrangement. Most ETFs using covered calls take a blanket approach, selling options on their entire portfolio, which generates income but can limit your gains if the market surges. IDV's approach is significantly more sophisticated. What makes IDV exceptional is its selective, tactical method. The fund managers analyze each stock individually to determine the optimal timing for selling options. When a particular holding moves sideways or slightly declines, they might sell call options on that specific stock, generating extra income precisely when that investment isn't appreciating. The premiums collected help offset potential losses or provide additional income beyond dividends. For stocks showing strong upward momentum, managers might choose not to cap potential by writing calls against them. This selective methodology allows IDV to participate more fully in upside moves while still generating substantial premium incomes from other positions. This strategy creates resilience across market conditions. In volatile markets, the covered call strategy provides a cushion against downside volatility. In sideways markets, where most investments struggle, the strategy generates return through option premiums. In rising markets, the selective approach lets IDV capture a good portion of upside. While the fund's 0.66% expense ratio exceeds many passive ETFs, you're getting expert managers implementing a complex strategy most individual investors couldn't realistically execute themselves. Specialized knowledge that translates into real value. The combination of international dividend stocks and tactical covered calls creates a powerful income engine. By laying option premiums income on top of substantial international dividends, IDV creates a cash flow stream potentially large enough to replace employment income for those with sufficient positions. This approach works across different market conditions. In bull markets, selective covered calls allow for appreciation while generating income. In bear markets, option premiums buffer against losses. And in flat markets, IDV can still produce meaningful returns through both dividends and option premiums. While IDV's performance across various market conditions might tempt you to jump in with both feet, consider this paradox. The very features that makes this ETF so appealing, its international exposure and income-generating strategy, also introduce complexities that could significantly impact your bottom line. Let's examine whether these trade-offs align with your personal investment goals. Every investment decision requires weighing potential rewards against risks, and IDV is no exception. Before allocating part of your portfolio to this ETF, you should understand what you're signing up for beyond the attractive returns and yields we've discussed. Have you ever prepared a complex recipe where balancing spices is crucial? Add too much and the dish becomes overwhelming. Too little and it lacks character. International investing works similarly. You need the right balance of exposure and protection to create a satisfying portfolio. International investment faces a trio of unique challenges. Currency fluctuations can transform successful foreign investments into disappointing ones when converted to US dollars. A company performing well in euros or yen might show diminished returns when those currencies weaken against the dollar. Political instability can impact markets overnight through policy changes or regional conflicts. Additionally, varying accounting standards across countries make it harder to assess companies' true financial health compared to familiar US GAAP standards. IDV's portfolio concentration presents another consideration. With approximately 100 holdings, it's more concentrated than many broader international funds, meaning individual stock movements have a more pronounced effect on overall performance. This could lead to greater volatility compared to more diversified options. The fund's size matters too. At approximately $200 million in assets, IDV is relatively small compared to mainstream ETFs. While its recent 30% growth is impressive, the smaller asset base could impact liquidity during market stress, potentially leading to higher transaction costs. Tax considerations add complexity. International dividends often receive different tax treatments than domestic ones, and income from the covered call strategy typically gets taxed as ordinary income rather than at favorable qualified dividend rates, particularly important for taxable accounts. Financial advisors typically recommend limiting specialized ETFs like IDV to 5 to 10% of your total portfolio, depending on your risk tolerance and timeline. Younger investors might accept higher allocations, while those near retirement might prefer more conservative positioning. For those interested in international dividend investing but concerned about IDV's approach, alternatives exist. Funds like Vanguard International High Dividend Yield ETF, VYMI, offer exposure to international dividend stocks without the covered call strategy. The ideal IDV investor values current income over maximum growth, has moderate risk tolerance, understands currency risks, maintains a minimum to long-term horizon, and accepts active management despite higher expenses. If this matches your portfolio, consider consulting a financial advisor about how IDV might enhance your investment strategy. So here's what it comes down to. Financial freedom isn't about working harder at your current job. It's about putting your money to work more effectively than you ever could. IDV represents exactly that kind of opportunity, a singular investment vehicle that could potentially generate enough passive income to rival or even surpass your 9-to-5 earnings. The day my investment earned more than my salary was the day I truly became free, one investor told me after diversifying internationally. Transform from a stagnant, US-focused approach to a dynamic global income engine. Build a portfolio that pays you to live, not just for retirement. Your financial transformation begins today. Your future self will thank you.